Hey there, everyone. Today on the Final Bar, we'll wrap this week talking about the market whimpering into the weekend, the QQQ closing below its 50-day moving average. Our market trend model confirms a short-term bearish thesis for the equity market averages. Finally, we'll open the Final Bar mailbag. How can you use Fibonacci retracements to identify potential support levels? Ladies and gentlemen, this is the Final Bar. Hey there, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. Our StockCharts platform was created about 25 years ago to empower investors, individual investors, self-directed investors, to better understand the markets. I was at the Money Show in Las Vegas earlier this week. We talked all about situational awareness, focusing on how you understand and appreciate where you're at relative to your surroundings, right? What's working, what's not, what's going up, what's going down, and having a disciplined, consistent process for trying to make those evaluations. I hope and we hope that the Final Bar becomes a part of your normal daily market routine, trying to make sense of what we learned from the markets and help you get set up for success going forward. Now, today we're going to talk about inflation data. We talked about CPI earlier this week. Today was the PPI number, a little hotter than normal, suggesting inflation may not be the all-clear sign we may have expected. Technology, growth stocks sort of rolling over today, or continuing that rollover that we've been tracking here for the last couple weeks. The month of August has not been particularly good for growth, and the QQQ finally closing the week below its 50-day moving average. We have a lot of charts to review as we wrap this week, so let's get right to it. Before we get to the charts outlining the performance of stocks and other ETFs this week, did want to ask you a question from our poll. We asked you recently which ETF performs best over the next 3 months. Gave you 4 different industry ideas to work on: oil services, the OIH; semiconductors, the SMH; banks, as reflected in the KBE ETF; and gold stocks using the GDX. So it's interesting to me, as always, what got the most votes, which was oil services. I would probably agree on that one, right? If I was trying to find an area of the market showing strength in August and compare that to all the sectors, the previous leadership sectors, like technology, consumer discretionary, semiconductors, which were one of the items, but others like software and other parts of those sectors, all rolling over. Strong July, weak August, and a seasonally weak period that we're in. Energy has been the opposite, right? Energy stocks have been fairly resilient. Strong July, but even a stronger August. And being up in August means you're outperforming in a pretty significant way. I would say the OIH, certainly an interesting ETF, breaking to new highs, making a new 52-week high again this week. The challenge for something like oil services is a potential bearish divergence. Now, we highlighted those bearish divergences in June and July for a lot of technology stocks, a lot of technology groups and ETFs. Many of those have now corrected. You're seeing kind of a similar pattern now with energy continue to go higher in August as the momentum is going down. But I think what's most encouraging to me relative to any of those other 3 ETFs is the fact that the relative strength, the relative performance has remained strong. In general, we want to be in things that are outperforming. We don't want to be in things, or we're going to be underweight things that are underperforming. I think the OIH, probably the best setup of the 4. I would agree with the masses here, 48% saying OIH. I would agree. Let's keep on going here. Review the week. Let's look at today's action on Friday. We'll connect that to the weekly movements. Have a couple different looks to pay attention to. A weekly chart we like to follow, but also looking at the performance table, which we haven't done too often. Then we'll look at some individual charts that I think are worthy of your attention. Major averages kind of mixed today. The S&P finishing slightly down, about 0.1%, closing the week here around 44.64. So again, I'm a big fan of big round numbers, sort of lines in the sand, levels, and just thinking about where we're at relative to that key level. So I've talked about Bitcoin and 30,000. Until it gets above there and stays there, Bitcoin's just not getting too good. With the S&P, until it can get back above 4,500, this is a market kind of in a pullback phase for now. So ending the week remaining below that level. Now the NASDAQ really pushing the way lower today. The NASDAQ composite was down 0.7%. The Dow, which is a little more dominated in sectors like industrials and energy and those sorts of things, actually finishing about 1/3% higher 0.3% to the upside. Mid caps and small caps really unchanged from Thursday's session. So again, it was kind of NASDAQ types of names down, everything else kind of flat to slightly positive. The VIX actually moving back lower. So even though growth stocks were down, volatility actually came down as well. We're just below 15 on the VIX. Again, we've talked about volatility a couple times this week. We looked at the chart of the VIX. On Wednesday's show, I want to say we did a segment called Getting Sentimental. We focused on sentiment indicators, including options-related data like put-call ratios and the VIX. So if you missed that one, I would go back to Wednesday's show. We dug a little deeper into volatility regimes and how that's changed. Overall, I think higher volatility here in August and September really would sort of match with the correction thesis, sort of the pullback beyond what we've seen so far. For now, not really confirming that. The VIX actually coming off slightly from where we were on Thursday's close. A lot of movement in interest rates. Now, this Bill Gross guy, who I'm told is pretty knowledgeable in the fixed income market, of course, a longtime fund manager at PIMCO, one of the largest bond funds at the time, had mentioned that 10-year yields probably going higher. He talked about 4.5% as being sort of a fair value for the 10-year, given what we've seen. That's obviously above current levels, so rates overall moving higher. And my conversation with Ms. Schneider yesterday, we talked about bond prices rolling over, 100% agreed. TLT sort of breaking down, continuing to press that downside today, down about 0.25%. Interest rates overall moving higher. Skip the short end to go to the 5, 10, and 30-year points all moving to the upside. 10-year yield finishing the week around 4.17, 4.17%. 30-year yield just below 4.3%. So again, those rates above 4%, I think that's the beginning. I think there's more to be had there. A number of my conversations recently, again, with guests who tend to be more technically oriented, we're all picking up on that, the fact that bond prices are going down. So it's not like stocks go down and all of a sudden bonds are providing a great safe haven. Stocks are actually still outperforming bonds just fine. And it's rising rates that I think are a part of that reason as to why that's the case. Dollar going up just a little bit, about 0.25% higher than yesterday's close, Thursday into Friday. Commodities, to be honest, not a ton of movement here. Gold, silver, oil prices, all very similar to where we were Thursday. Wasn't a big move for that area of the market, although energy stocks actually had the best day by far for the 11 S&P sectors. We'll come back to that in a minute. Finally, cryptocurrencies, again, just slightly in the red. For me, when I'm thinking of Bitcoin and Ethereum and other cryptocurrencies, it's all about follow-through, right? It's all about having an established level of resistance, which I think we do, and it tends to be big round numbers. For Bitcoin, it's 30,000, maybe 31,000, which was the recent swing high. On Ether prices, 2,000 is a big round number, and if you look at what's happened recently, we have had a number of attempts to try to get through those levels and have failed to do so. So I'm monitoring these to see if and when we actually break above there. I think it's going to be more when and not if. I think you see cryptocurrencies rallying, but for now, not really. We're not seeing a rotation away from stocks into cryptos at this point. It's seeing sort of an everything coming off, sort of a reduction in risk assets for now. Finally, looking at the 11 S&P sectors, energy number one, up 1.6% for the XLE. Finally, after that, healthcare and utilities both up about 0.6%. On the downside, 4 of the 11 sectors actually finished in the red. You have technology, communication services, consumer discretionary, 11, 10, and 9 at the bottom of the list. So this is really a continued rotation away from growth and into other places. That's a theme we've been talking about. I think that theme really continues through this weekend. I think in subsequent weeks, next week and beyond, that's a rotation I would continue to look at. I'm feeling more and more comfortable with the idea of talking about this as the great rotation of 2023. We'll see. Maybe it's one of many, but for now, I think it's a really important theme that will be the story of 2023 with this rotation away from growth and into cyclical sectors for sure. Let's look at what we call the Wrap the Week chart. This is just looking at what's happened over the course of the last 5 trading days. We start the clock Friday, August 4th. We go to where we're at Friday, August 11th. What happened? So S&P down 0.25%, about 0.3%. So not a big down week, to be honest with you. But again, I think at this point, as we get into more of a corrective sort of feel, as you see stocks pulling back, maybe holding their 50-day, but in more and more cases, maybe not holding their 50-day. These down weeks, I think, are becoming more and more common, and it should be more about what we probably expect. So the S&P having a down week, a number of things actually underperformed the S&P this week. Here's bond prices. The TLT was down 1.2%. So again, think about stocks coming off. Okay, we want to rotate into bonds because it's more of a safe haven. This is another week where that's not actually the case. Stocks down, bonds down even more. So the stock to bond ratio actually going up this week, continuing to show how stocks have just been a better performer than bonds over time here, certainly in recent history. Here in gold is the GLD, sort of a spot gold play, down 1.4%. In pink, we have the NASDAQ 100, and in purple, the Russell 2000 Small Cap Index. Both of those down about 1.6%. The worst performer, emerging markets, down 2.4%. It's interesting that, when you think of emerging markets, I immediately think of China, India, some of those markets. China actually having a nice bounce. Yesterday, we talked with Ms. Schneider about the FXI. Worth a look if you've been ignoring China, I think for understandable reasons with all the negative news flow. From a technical perspective, starting to see signs of life there for sure. A couple things actually finished the week in the green. Crude oil prices up 0.6%. That's using the USO. The dollar up about 1%. Also, Bitcoin, even though it was up a lot more earlier this week on Tuesday, sort of pushing to the upside, but by the end of the week, sort of settling back down. So those are your two winners for the week. Bitcoin and the US dollar, both up about 1%. So no significant, huge moves. This wasn't a dramatic move. It's interesting, thinking about this week with the inflation data coming out on Thursday and on Friday, certainly a potential for a big rotation higher. You didn't see that. You're seeing stocks continue to pull back. Even though the inflation data yesterday, the CPI number is actually pretty encouraging, implying that the Fed sort of getting that soft landing thing right, and expectations in terms of Fed policy through the remainder of this year, basically market pricing in no additional changes, no additional rate hikes, and really no pullback in rates until at the earliest beginning of next year. PPI number today, which is the producer price index instead of the consumer price index. So the basket of goods that producers are basically dealing with, actually a little higher than expected today. So overall netting out to a market still, I would say, in a gentle pullback sort of phase. Let's look at a daily chart of the S&P to sort of see what happened through the course of this week and where we left things. So, we've been talking about the line in the sand for us around 44.30, now about 44.40. And that is taking two different measures. The 50-day moving average for the S&P is right around that point. And also one of the trend lines that we have on our chart here, taking the March and May low, it's kind of lining up at that same place. And anytime from a technical perspective, when you have what's called a confluence of support, that is a Connie Brown technique that I remember learning about years ago, which is basically you have different indicators, different calculations, different inputs, different types of indicators, all kind of coalescing to a very similar conclusion or a very similar price point. So what you call a confluence of support basically should give you more conviction that this may be an important level to watch. And if we hold that, sort of confirms that the trend is still okay. We break it, sort of puts an exclamation point on that breakdown, telling you it's probably pretty meaningful. So the S&P making a lower low most of the 5 days this week. You can see today, even though we closed above the open, we're right sort of at that support level. So the NASDAQ actually getting below its 50-day moving average. The S&P holding it for now, and I would be very keen to see going into next week. I think that's an important level to watch. We break that, and we will immediately start talking about further downside objectives. I think they're pretty clear on the chart here, but you don't have to worry too much about 4,000 if we're still holding above 4,400. So one thing at a time. All large losses begin as small losses, so let's make sure that we focus on a short-term level of support, see if that's able to be held. I mentioned the NASDAQ 100. Here's the QQQ. A bit of a doji candle today where the open and close are right about at the same level. Might be something important to watch at the beginning of next week. May suggest a bit of a short-term bounce. We'll see. For now, though, the QQQ closing below its 50-day moving average. And again, while the 50-day is not the most important or the only thing you want to be watching for, it's certainly a meaningful one. And for me, I know a lot of investors watch that 50-day because a pullback to a 50-day or a 10-week moving average is often an interesting a potential opportunity to layer into a position, right? So you're riding something higher as the trend overall evolves higher, and you'll have these pullbacks to an ascending 50-day moving average. That can also often be a good time to consider maybe buying on the dips. But once that stops holding, that might tell you that that uptrend you've been betting on is maybe starting to rotate. That's my concern for this market going into next week and really through the remainder of August is a correction is not done and we have further downside to be had. So the Qs, as I mentioned, closing below the 50-day moving average. Now, I mentioned sector returns. One of the ways, if you're thinking about a group of ETFs like sector ETFs or asset classes or a watch list or whatever, the performance tables that we have on stock charts can be really helpful for that. If you have any chart list, you may be familiar with sort of the summary view, which sort of shows a bunch of different high-level information. You have the chart list view, where you can scroll through the charts, the candle glance view that we feature on the show pretty regularly, looking at a bunch of the charts on one screen. The performance table is one of the newer additions we've had, and basically you can sort this list of ETFs just by clicking on any of the column headings. So we can see year to date, the FANG sectors have certainly been the strength, right? Year to date, even with recent pullbacks, communication services up over 40%, technology up almost 35%, consumer discretionary, the XLY, up 32%. But look at the last month. All of a sudden, you'll find them here more toward the lower end of the list. In the last month, technology is actually down 3%, while energy is up 8%. So that shows you sort of what a change of character I think we've had. Again, is what I would probably call the great rotation of 2023. Now, let's look at the last week, sort of focusing on what we learned. Your top performing sectors for the week: energy up 3.4%, healthcare up 2.5%, utilities and real estate sort of tied for third, right around just below 1% higher for the week. So it tells me energy has certainly been the newer leadership. This has been an emerging area of leadership as the XOP, the OIH, the XLE. These are sort of the most liquid energy ETFs, all rotating higher, not just in July, but following through in August. Healthcare is an interesting one because you might be surprised to see healthcare at the top of the list for this week. I know a lot of investors have been avoiding healthcare because it's been a choppy, noisy, challenging space. You may want to pay attention there. It's actually starting to show some signs of strength. At the bottom of the list this week, technology down 2.5%. We've highlighted this week charts like NVIDIA and Microsoft and Apple, of course, gapping lower this week, continuing to move lower last week and continue to move lower this week. Consumer discretionary materials both down about 1% for the week as well. Let's go back to the dashboard, and I have two charts that I like to keep on the dashboard. Again, one of the things that our developers are working on is what we're calling panels. Basically, our dashboard uses a series of little widgets, or what we call panels, and these are pretty default or pretty determined as to what panels you can show. We are planning to open the door and unlock the ability to customize your own dashboard with all sorts of cool different widgets that we are currently developing, and a lot more ideas that we have going forward. So look for in the future for your dashboard to have a lot more flexibility. I'm super excited for that. But one of the things you can do now is click on the little gears in the upper right and make it a little more customized to your own work. What I like to do is actually incorporate some of my most important charts right on the dashboard. So when I bring up stock charts for the first time any day, I can actually look down at these important charts to me and just focus on the big picture. Our market trend model turned bearish on the short term last Friday, continuing to be bearish today. The NASDAQ 100, the mid cap, the small cap market trend models, all bearish on my short term time frame, or on the short term time frame as of today's close. The medium term and long term, of course, still constructive, and that's about what the weekly chart of the S&P is telling me. It's telling me short term, look out, we're in a corrective phase. Medium term, long term, I think still constructive. That's about what I would say visually looking at the chart. That's what the market trend model that I use is confirming for me. Last thing I'll show you here, then we'll continue on with the show, is different sort of measures of strength and weakness. Offense over defense really starting to favor defense. It's just started to roll over, but if you look at the last couple weeks, it's been lower through the course of every week. And so you're seeing a bit of a rotation away from consumer discretionary into consumer staples. Not a huge, obvious run for the hills type of rotation, but maybe the beginning of something. Where you are, I think, getting some very clear signals are with breadth indicators. On Tuesday's show, we did a segment banking on breadth. I would encourage you to go back and review some of those bullet points if you missed them, because we talked about things like the bullish percent index, percent of stocks above moving averages, and some other breadth indicators like the McClellan oscillator, I think all really rotating and confirming this sort of corrective or pullback phase that I think we find ourselves in today. That's it for our Wrap the Week segment, sort of checking in on some of those different charts that tell the story of this week. We're going to continue on with our mailbag in just a moment. Before we do, a couple of quick announcements. First off, our mailbag is fueled from all of you sending in your questions. Thanks again. A number of you sent in some really good questions this week, some of which we'll feature today. We would love to answer your question next week. You can email us your questions at thefinalbar@stockcharts.com. On X, just hit us with a comment at FinalBarSCTV, and on our YouTube channel, just put a comment below the video you're watching. Our channel's called Stock Charts TV. We also have a Stock Charts channel with some really good content related to investing 101, also relating to the Stock Charts platform. So check that out as well. Also, to let you know, our next YouTube live Q&A will be happening next week on Wednesday, August 16th, 1 p.m. Eastern, 10 a.m. Pacific. We'll be doing a live Q&A. Why do we do these live Q&A sessions? Because it is really fun to get questions directly from you in an informal, sort of laid-back setup, and we'll go through as many questions as we can in about 30 minutes. We have it scheduled on our YouTube channel, so if you go to it now, you can actually put a reminder to make sure you get alerted to it. But mark your calendar. Next Wednesday, August 16th, 1 p.m. Eastern. Our plan is to do those every Wednesday at 1 p.m. Eastern, 10 a.m. Pacific. So I hope you can join us for our next YouTube live Q&A next week on Wednesday. Let's continue on with the Final Bar mailbag again. Thank you, everyone, for all of your great questions. And let's get to question number one. Dave, if price above the 38.2% Fibonacci level means that the trend is not broken, when is the trend broken? And this comes in response to a comment I made apparently earlier this week. It sounds like me, so I think you're right. You know, I mentioned as long as we hold that 38.2% Fibonacci level, things are not getting that bad. And I don't remember if we were looking at the chart of the QQQ, but I think so. That's actually what comes to mind. So I think, well, that's not it. I'm looking at Fibonacci retracements. There we go. I was looking at the wrong tool. All right, so generally speaking, Fibonacci 101 is you have a big move in a chart, right? In a stock or an ETF or whatever you're looking at. The way that you should think about Fibonacci retracements, in my opinion, is take that big move, right? Whatever that means to you. So for me, looking at the chart of the QQQ, we bottomed out in October, then we had a couple retests in November and December. And this is when the Qs were kind of in a consolidation phase here at the lows. Then we sort of took off, had that higher low, and continued on. And so I think of that December low as the beginning of this big move. And I think of the high from a couple weeks ago, sort of mid-July, as the end of that move for now. So what that means is I basically said this was the beginning, that's the low in December, here's the high in July. Now, as we rotate between those extremes, at what point should I expect potential support? And my general comment, I think what I was getting at was, you know, trying to put things in perspective. I think a lot of times people try to simplify and think, you know, is this chart bullish or bearish? And that sort of question is actually really hard to answer because it really depends on your time frame, right? What sort of time frame are you looking at? If you're talking about the next couple days or the next couple weeks, I would say, yeah, the chart of the QQQ is a little more bearish than bullish because we've now broken the 50-day. We had a lot of bearish divergences that have now followed through, and I think we're failing to hold short-term support levels. So on a tactical time frame, I think clearly negative. But you know what you have to remember is sort of that higher levels, right? Sort of that bigger picture is that the NASDAQ 100 could go from a high around 390 to a lower around 340 and then rotate higher, make a new high into year end, which I'm not saying is guaranteed, but is certainly possible. That would actually make all of us happy, right? In the short term, the bearishness was proven correct because the price continued to go lower. But because we held that first Fibonacci level, the longer time frame, right, that bigger picture is still actually pretty constructive. And that's one of the ways I think you can use Fibonacci retracement. It's kind of a simple measure of saying, is this just a brief pullback, sort of a corrective move within the context of a longer-term uptrend? Now, your question is, what would tell you when the trend is broken? Now, it's hard to sort of generalize and say, if XYZ happens, then the uptrend is now over, because I think there's a little bit of a nuance. That's where I think the technical analysis can become a little more sophisticated, because it depends on what particular techniques and what time frame you're thinking about. But if we just look at Fibonacci retracements in general, that means for me, holding that 38.2% level means the larger size or the larger scale time frame uptrend is still in place. We break the 38.2% level, you immediately go to the lower objectives. That means it opens the door to the 50% retracement around 323, the 61.8% retracement around 308. And that is sort of the lower boundary of a consolidation phase. And again, I'm generalizing here. As long as we hold that 61.8% level, that means that it's at worst a consolidation and at best maybe just a deeper drawdown. We break the 61.8% level, and if you've not openly declared it a raging bearish phase, I think that should be your point of no return of remaining bullish on any time frame, because what that means is high likelihood of a retest of the lows. So that's how you can kind of think of the Fibonacci levels as a framework. And if you're familiar with something like Elliott wave analysis, it's that sort of thinking, just with different proportions and different levels, and using more of a wave-based approach, but coming up with a lot of the same conclusions. So that's how I would use some of those Fibonacci retracements to try to label, is this just a brief pullback? Is this a deeper correction into some sort of consolidation? Is this a clear downtrend? Those are some of the levels I might want to look at. And I would also say use other techniques like moving average and others to maybe confirm those. Next question. Dave, what would confirm a rotation to the downside, a break of the 50-day or the 200-day? And you're asking this, I think, about the S&P 500. So let's look at my daily chart of the S&P. Again, a little busy. So sorry for this. Here, what we're going to say, new clean chart. And I'm going to put this here in a random chart list. And then I'm going to do this very scary thing, which is delete all of my annotations. I hate doing that because I feel like I might be getting rid of stuff. There we go. So here's a new clean chart of the S&P 500. Your question was, what would confirm a rotation to the downside? So of course, our previous answer was thinking about how to use Fibonacci retracements to try to make that assessment. When we're thinking of moving averages, in general, what you have to remember when you have multiple moving averages, you have the 50-day, which is sort of the short-term time frame, the 200-day, which is more of a long-term time frame. So here's how I would think of it, right? Generally speaking, like back of the envelope, is you pull back to an ascending 50-day moving average. That is a constructive pullback, and what I mean is it's a brief pullback within a larger uptrend. Those are often the times when you can think of it as buying on the dips and riding the next wave higher. We break the 50-day, and that's where things become a lot more significant. So for me, very generally speaking, holding the 50-day is super important. That's why I think charts like Apple and Microsoft, when you pick up on me sort of already declaring technology as a lost cause in the short term, it's because we've failed to hold the 50-day. And when that starts happening, I find that is a feedback loop, a negative feedback loop, meaning further price deterioration usually adds to further selling. Further selling pushes the price lower. Lower prices fuel additional selling. You can see how this continues lower and lower. And that trend usually continues until aggressive buyers or really optimistic buyers, value-oriented buyers, find enough of a pullback that they're willing to come in, and that's what can start to provide a bit of an upswing to be had. So for me, the 50-day moving average is the main one to look at. Now, you may think of another moving average like the 200-day or something else may be more important for you, and that's probably more related to our time frames. In general, I'm looking out about 1 to 2 months on average, although that can fluctuate based on the trends that I'm seeing, but that's kind of the general time frame that I'm thinking out towards. So with that in mind, a break of the 50-day is pretty meaningful. If you're more of a very long-term investor, maybe you're looking at a weekly chart, looking at the 40-week and 150-week, and those for you are a better measure of trend and pullback and reversals. I would say, as always, make sure that the charts and the indicators and the settings you're using are really in line with the questions you're trying to answer, your investment horizon. Next question, Dave, has the put-call ratio recovered to neutral? Doesn't that override a bearish conclusion? A number of you, I think, picked up on when I was talking about sentiment. I think that was on Wednesday's show. We looked at the put-call ratio, and one of the things we talked about was how those put-call ratios had been quite low and actually had bounced back to the upside. We can look at the total put-call ratio. I think we spent a little more time on that this week. And what we were talking about was basically, look, here's the real low in the put-call ratio, or an unseasonable low compared to where we've been, the lowest reading that we had in quite some time, actually about a year and a half. And I sort of focused on that extreme low reading. And what you said was, well, what about now? It's kind of pulled up quite a bit, and isn't that basically eliminating that? So yeah, I mean, I guess the short answer to your question is absolutely. I think when you're looking at indicators like the put-call ratio, for me, it's similar to looking at something like RSI. And I have this horizontal line just looking at the current level and then going to the left to see where we're at relative to where we've been, or previous levels, how they line up with today's reading. So yeah, I think with put-call ratios, I think for me, the actionable reading is when you're at extremes. It's similar to an RSI and looking for when the RSI is overbought or oversold. When the RSI is kind of like at 48 or 54, is there a lot of signal today? Not really, right? It's more of a neutral kind of everything's kind of normal reading. And if you think about what that calculation is on like the RSI, that basically means up and down days are kind of even. And that means there's no real signal. When the RSI is overbought, or when there's a bearish divergence, when the RSI is oversold, or there's a bullish divergence, that's when the indicator is more actionable. So I think with technical indicators, there's not always a signal. The signal comes at a particular time, and usually when something's different, right? When something's changing. at some sort of inflection point. That's why I was focusing on the put call ratio being unreasonably or unseasonably low, because what that means is that there's a signal. At this point, the put call ratio is kind of middle of the road to where it's been for the last 16 to 18 months. So I would argue at this point, no real signal. I would be very much looking as, or if and when this pullback phase continues, does the put call ratio get higher and higher? Do we start to get to those extreme readings that we saw in 2002 that lines up with some of those actionable, buyable pullbacks? We're not there yet. So in my opinion, we're sort of wait and see mode to see if that put call ratio can get up to an upward extreme. For now, sort of middle of the road. Great question, and thanks for asking about put call ratios. Next question. Dave, would you consider Boeing a bullish chart here, and why? I love the simple and straightforward nature of your question. Let's get right to it. I'd mentioned Boeing earlier, and earlier this week, just highlighting the stock because it came up on my new swing highs list. And you know, honestly, what I often do, and at least once a week, is run a scan for stocks making new 3-month highs and stocks making new 3-month lows. And I do that to really capture the beginning. I like things that have been in a basing pattern, meaning they've consolidated, and all of a sudden something changes. And the way that you can tell that something changes is you have a base, meaning you have a consistent resistance level, then we break up through that resistance level. And I think that's what we've seen with Boeing. The gap higher here is pretty interesting. To me, this represents what we call a breakaway gap, which is the market has had a particular feel. It has had a consolidation, what we call a basing pattern, between around 220 on the upper end, and we'll call it like 190, 200 on the lower end. Then all of a sudden we broke above there, and we broke above and gapped above that level of resistance, closing the day above 230. And from there, we've sort of been chopping around, but overall still sort of holding the upper end of that day. And I think 230 for the short term is kind of a nice tactical support level. I think as long as we have now broken above that base around 220 and hold that, look at the 50-day, which is right about at that level as well, I would be inclined to think that this is a bullish chart until proven otherwise. I go with the innocent until proven guilty approach. When a chart has broken out, I'm going to assume that that breakout is good until the price tells me the breakout is no longer valid. So until we get below that base, below the 50-day around 50-day moving average around 220, I would say Boeing still a constructive chart. Final question, then we're done. When QQQ breaks down and institutions start selling, how is that order put into place? That's a really good question, to be honest with you. And I do get some random questions about how institutions actually trade around something. You know, what you have to remember, and again, what your particular question that you ask is, when the QQQ falls below the 50-day moving average, and let's say an institution uses that as a signal, your question was, what do they actually do? If you're an individual and you're trading like 1,000 shares of the QQQ, you just put in your order and you're done, right? But if you're a big institution running billions of dollars, you have to be a little more thoughtful about what you do, because if you would go dump, you know, $100 million worth of sell orders, you could completely rupture a stock very quickly. And that is one of the tools, or a set of tools, that we would use as institutional investors are literally tools that calculate. You look at the average liquidity, average volume. You want to make sure you're not more than X% of the volume on a given day, because you don't want to have an outside influence on that particular stock. You don't want to telegraph to the rest of the street and other investors what you guys are trying to do. So you try to minimize the impact. So you use things like dark pools and other techniques and other sources of liquidity to try to get those trades. So the answer to your question is use a number of different things. In general, the way a buy-side trading desk would be evaluated, and again, I'm generalizing, would be using the VWAP, the volume weighted average price. You can actually see the VWAP. So if we look at a chart of the QQQ, I'm going to look at a quick intraday chart. Let's look at like the last 2 trading days. And if you look below sharp charts, and on ACP, we have the same thing. Under the section called overlays, you will see the VWAP, volume weighted average price. Now, this is something you can calculate, but basically looking at every trade during the day, and you look at the volume versus the price, and you multiply those together. And so over the course of the day, as the price is evolving, you're looking at the price and the volume, and you're calculating this volume weighted average price, or VWAP. In general, a buy-side trading desk is evaluated by where they're executing during the day or during the stretch, the period of that trade, on a volume-weighted average price. So as long as they are buying below the VWAP for that period and selling above the VWAP for the period, they are basically finding ways to buy in on the weaker parts of the price action and selling on the stronger parts. And so that's for buy-side traders, they know very closely where the VWAP is, and they calculate how they're getting filled. And a lot of traders are actually evaluated based on their ability to trade, and that is the value that they add to a firm, allegedly, is to execute around the VWAP. Now, in 2023, there are a lot of algorithmic tools, so you can say, I don't want to be more than X% of the daily average volume. I want to make sure I'm at this point relative to the VWAP, and you can do all sorts of crazy things to try to automate that. But on larger positions that you're really trying to change, like a new fund manager, you need to really rotate a lot of positions. It has to be a little more of a manual process, and you have to be thoughtful. But the reality is big funds will be breaking trades out over days, if not weeks. And I know if we would accumulate a big position in Disney or Apple or something like that, we would have to take a lot of time to accumulate that position. So it's not as, and to be honest, I would say we were very envious of small individuals that could just make the trade and move on. The actual logistics were actually quite complicated and quite a challenge. That's it for the mailbag. Thank you guys so much for all those thoughtful questions. We have to wrap the show and go to the 3 and 3, 3 charts in 3 minutes to tell the story of this market environment. Here is chart number 1. We're looking at the QQQ, and I love that question about thinking about Fibonacci retracements. Like, where is a market bent but not broken, and when would you declare the trend broken? I think with the QQQ, Fibonacci retracements can provide a good sort of back-of-the-envelope idea about where we've come from so far in this pullback and what sort of downside we could expect and still be within arguably a long-term pretty constructive chart. Using the December low and the July high, we've gone down to around 366, down from around 387 just a couple weeks ago. We go down to 340, which would be the 38.2% retracement. That's about another 7.5% below current levels, below today's close. So that shows you the kind of downside pullback we could have in the coming weeks and still actually be within reasonable expectations for a pullback within a bullish phase for the year. So I think that gives you the potential downside target for the Qs and actually still kind of be long-term okay. Chart number 2, the 10-year yield. We had a great conversation this week and in previous weeks about bond prices currently continuing to go lower. The TNX, or $TNX, tracks the 10-year yield point. You know, I've heard some commentators recently going on financial television talking about rates going back down, and that's just not what we're seeing yet. 10-year yield remaining above 4%, almost to 4.2%. Overall, I'm seeing rates in an uptrend of higher highs and higher lows. I'm seeing the TLT in a downtrend, lower lows and lower prices. So forget about what you think should the 10-year yield should do. Overall, the trend, I think by the basic Charles Dow definition, is still up. And what that usually means is a tougher environment for growth stocks and a better environment or more hospitable environment for cyclical sectors and value-oriented sectors. That's certainly what we've been seeing. That brings us to chart number 3, which I'm now calling the Great Rotation of 2023. Here's the XOP, which is an oil and gas E&P ETF. That means exploration and production. Strong July, and most stocks had actually a strong July, including growth. But August has been a big pullback time for growth, but a continued upswing for energy. Here we're looking at the relative strength of the XOP, exploration and production, and also the OIH, which is oil services. Both of them have been outperforming over the last 8 to 10 weeks. Compare that to more growthy measurements like the XLK, which is in purple, semiconductors in brown. Look how the relative strength is rolling lower and how that's really becoming magnified in August. So we're seeing that rotation away from growth into value. I think this is just the beginning of that theme, which may be a big part of what we're talking about in coming weeks and months. Folks, that's a wrap for this week. Thank you so much for joining us every weekday after the close for the Final Bar. Don't forget about our next live Q&A next Wednesday at 1 p.m. Eastern. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe. We'll see you next week.